The Social Security earnings limit is being eliminated, and here is what that actually means for you. There is a proposal moving through Congress right now that could change the way millions of Americans think about working and collecting Social Security at the same time. If you have ever wondered whether you could keep your job, stay active in your career, and still collect the Social Security benefits you spent decades paying into, this is directly relevant to you. And even if retirement is still a few years away, understanding this proposal now could meaningfully change how you plan your transition out of the workforce. The proposal is called the Senior Citizens Freedom to Work Act of 2026. The core idea is straightforward. It would completely eliminate the Social Security earnings limit for people who are under full retirement age and still working. Not reduce it, not adjust it, not tweak the threshold, eliminate it entirely. To understand why that matters, we need to talk about what the earnings limit actually is, where it came from, and what would realistically happen if it disappeared. Social Security has an official age called full retirement age, which for most people currently falls between 66 and 67, depending on your birth year. You are allowed to start collecting benefits as early as age 62. But if you claim before reaching full retirement age and you are still working and earning income, Social Security applies what is called an earnings test. Here is how that works in practical terms. If you are below full retirement age for the entire calendar year, Social Security withholds $1 of your benefit for every $2 you earn above a certain annual threshold. In recent years, that threshold has been around $22,000, though it adjusts slightly each year. So if you are 63 years old, collecting early benefits and earning $50,000 a year from a job, a significant portion of your monthly Social Security checks would be temporarily withheld. The word temporarily matters here. The money that gets withheld is not lost forever. Once you reach full retirement age, Social Security recalculates your benefit and gives you credit for the months your payment was withheld. Your monthly check going forward gets adjusted slightly upward to account for those withheld payments. So, over a long enough lifetime, the system is designed to roughly break even. But in the short term, it feels like a penalty. Many people who are working and claiming early experience a noticeable reduction in their monthly checks, and they find the whole system confusing and discouraging. The Social Security Administration lists 88 different types of compensation, along with detailed rules about what counts toward the earnings limit and when. Managing all of that takes real time and effort, both for individuals and for the administrative system enforcing it. The Senior Citizens Freedom to Work Act of 2026 would make all of that go away. Under this proposal, you could claim Social Security at any eligible age and earn any amount from work without having a single dollar of your benefit withheld. To understand whether eliminating this limit makes sense, it helps to understand why it was created in the first place. And when you look at the history, the original reasoning was actually quite logical, given the economic environment at the time. Social Security was not originally designed as a general income benefit people could access at a certain age, regardless of their circumstances. It was designed as retirement insurance. And when it was first created, retirement had a very specific and literal meaning. It meant you had stopped working completely. If you were still employed, you were simply not eligible for benefits at all. The thinking was that Social Security existed to replace income you had lost by leaving the workforce. If you had not left the workforce, you had not lost that income, and therefore you did not need the replacement. There was also a second motivation that often gets overlooked in modern conversations. When Social Security was created, the country was still recovering from the Great Depression. Unemployment was a serious national problem. There was genuine concern among policymakers that older workers staying employed were occupying jobs that younger workers desperately needed. The earnings test served a dual purpose. It encouraged older Americans to step back from employment and open up labor market space for the next generation. Over the following decades, both of those original rationales began to weaken. Americans started living longer. Medical advances meant that people in their 60s were often just as capable and productive as they had been in their 50s. The idea of a hard stop retirement became increasingly outdated as people began moving through gradual transitions, going part time, consulting, freelancing, or simply continuing to work because they found it meaningful. The economy also changed its thinking about experienced workers. Rather than viewing older employees as taking up space that should belong to younger people, businesses began recognizing the value of institutional knowledge, mentorship, and the kind of judgment that only comes from decades of experience. As public attitudes and economic reality shifted, Congress began loosening the earnings test. The penalty rates were reduced, the thresholds were raised, and then in the year 2000, a major change happened. Congress eliminated the earnings test entirely for anyone who had already reached full retirement age. From that point forward, once you hit that age milestone, you could earn unlimited income and still collect your full Social Security benefit without any reduction. What the Senior Support USA Citizens Freedom to Work Act of 2026 proposes is simply the next step in that same long-running evolution. Instead of the earnings test applying only before full retirement age, it would be eliminated for everyone at every age who is eligible to collect benefits. When you look at the full arc of Social Security history, this proposal is not a dramatic break from the past. It is a continuation of a trend that has been building for more than 2 decades. Now, the first thing many people want to know is what this would do to Social Security's finances, and it is a fair and important question. The system is already facing well-documented long-term funding challenges as the ratio of workers paying into the system shrinks relative to the number of retirees drawing benefits. In the short term, yes, eliminating the earnings test would increase costs. When someone claims benefits early and continues working above the earnings threshold, a portion of those benefits is withheld and stays in the system longer. If the earnings test disappears, those benefits get paid out immediately instead of being deferred. More money flows out of the trust fund sooner, but over the long term, the impact is considerably more modest than the short-term picture might suggest. The system is designed to be roughly neutral over a lifetime. If you claim early, your monthly benefit is permanently reduced to account for the longer period over which you will be collecting. The net lifetime payout does not increase dramatically. It just shifts earlier in time. There would also be behavioral changes that affect the math. If the earnings test disappears, more people would likely claim benefits earlier than they otherwise would. More early claims means more people accepting permanently reduced monthly benefits, which actually reduces the system's long-term liability per claimant, even as it increases the number of people drawing benefits at any given time. The honest assessment is that eliminating the earnings test would modestly affect the timing dynamics of the trust fund primarily because of cash flow shifting earlier. But it does not fundamentally change the core structural challenge facing Social Security, which is the long-term mismatch between payroll tax revenue coming in and total benefits going out as the population ages. Where this proposal would have its most significant effect is not on the system's balance sheet. It is on the decisions that individual people make about when to claim and how to structure their transition into retirement. Right now, the earnings limit acts as a genuine deterrent for a specific group of people. Those are people who have reached age 62 or older, who would like to start collecting Social Security, but who are also still working and earning meaningful income. For those people, the earnings limit creates a real financial disincentive to claim early. They know a portion of their benefits would be withheld, they find the rules complex, and many of them simply decide to wait rather than deal with the system during their working years. If the earnings test disappears, that deterrent goes away, and a meaningful number of people who are currently waiting would start filing for benefits earlier than they otherwise would have. For some of those people, claiming earlier would genuinely be the right decision. They would use that additional income to reduce financial stress, pay down debt, save more, or simply enjoy a higher standard of living during their final working years. And because they are still earning employment income, they would not be fully dependent on Social Security to cover their living expenses, which means the reduced monthly benefit from claiming early would not hurt them as severely as it would someone who is fully retired. But for other people, claiming early without fully thinking through the long-term consequences could be a costly mistake. The reduction in monthly benefits from claiming at 62 rather than waiting until full retirement age is 30%. That reduction is permanent. It applies for the rest of your life. If you live into your mid 80s or beyond, the cumulative cost of having claimed early can be substantial. And Social Security is for many Americans the only income stream in retirement that is both guaranteed and adjusted for inflation. The longer you live, the more valuable a higher monthly benefit becomes. The concern with eliminating the earnings test is that it removes one of the practical friction points that currently encourages people to think carefully before claiming. Some people benefit from the system essentially saying, if you are still working and earning significant income, you are not going to get the full benefit yet. That pause gives people time to think, to plan, and sometimes to make a better long-term decision. Whether government policy should be in the business of managing individual behavior through rules like the earnings test is itself a legitimate question. There is a reasonable argument that people should be trusted to make their own decisions about when to claim and that the government should not be creating artificial barriers. But there is also a reasonable argument that removing barriers can lead to decisions people later regret, especially when those decisions involve complex long-term financial trade-offs that most people are not fully equipped to evaluate in the moment. If this proposal passes, the retirement claiming decision becomes both simpler and more complicated at the same time. It becomes simpler in the sense that you no longer have to think about whether your work income will cause your benefits to be withheld. You can claim at 62, keep working as much as you want, and collect every dollar of your Social Security benefit without any reduction for earned income. But it becomes more complicated in the sense that the decision of when to claim now rests entirely on your own judgment about your health, your longevity, your financial needs, and your investment returns. Without the earnings test as a structural guardrail, you need to do that analysis yourself. The key variables are the same ones that matter for any Social Security timing decision. How long do you expect to live based on your health and family history? What return could you reasonably expect to earn on the extra money you receive by claiming early? What are your monthly expenses in retirement, and how much of them does Social Security need to cover? Do you have a spouse whose benefit might be affected by your claiming decision? And how much does the inflation-adjusted guaranteed nature of Social Security matter to you given the rest of your financial picture? What the elimination of the earnings limit would do is give you the option to start collecting while still working, which could be genuinely valuable if you use that money thoughtfully. For example, if you are 63 years old, still employed, and your monthly Social Security benefit would be $1,400 at that age, collecting that money while still receiving a paycheck gives you real options. You could direct that entire amount into a savings account or a low-risk investment. You could use it to pay off debt. You could use it to fund a health savings account or bridge the gap to Medicare eligibility. None of those options exist right now if your work income is above the earnings threshold. Regardless of whether this proposal becomes law in its current form, there are steps you can take right now to put yourself in a stronger position. The first step is to know your own numbers. Log into the Social Security Administration website and look at your projected benefit at age 62, at your full retirement age, and at age 70. Understanding those three numbers gives you the foundation for any claiming strategy conversation. The second step is to think honestly about your health and your family history. Longevity is one of the most important variables in the Social Security timing decision and also one of the most underappreciated. If the men in your family have routinely lived into their late 80s and your mother is still active in her 90s, that should weigh heavily toward waiting as long as possible to maximize your monthly benefit. If your health history suggests a shorter life expectancy, the calculation shifts. The third step is to model what you would actually do with early benefits if you received them while still working. If you would spend them immediately on living expenses, claiming early might not give you the financial advantage the math sometimes suggests. But if you have the discipline to invest those early payments even in low risk treasury securities, the break even analysis looks very different than the simple comparison most people run. The fourth step is to watch this legislation as it moves through Congress. The Senior Support USA Citizens Freedom to Work Act of 2026 has been introduced and has drawn bipartisan interest given that it aligns with the broader trend toward giving older Americans more flexibility. But introduced bills frequently change as they move through the legislative process. Amendments get added, provisions get modified, phase in timelines get debated. The bill that ultimately passes, if it passes, may look different from what was originally proposed. There is also a fifth step that does not get talked about enough, and that is having an actual conversation with someone who understands both Social Security rules and your broader financial picture. Most people make the claiming decision in isolation. They read an article, they run a quick calculation online, and then they file. But the claiming decision does not exist in a vacuum. It connects to your tax situation, your spouse's benefit if you are married, your pension if you have one, your investment accounts, and your overall income plan for the first decade of retirement. A financial planner who specializes in retirement income can help you run the numbers in a way that accounts for all of those moving pieces together rather than looking at Social Security as a standalone question. That kind of comprehensive planning is where people tend to find the most meaningful improvements to their long term retirement income. It does not have to be expensive or complicated. Even a single focused conversation with the right person can surface options and strategies that most people never consider simply because they did not know to ask. What this proposal really represents is the latest chapter in a decades long shift in how American society thinks about older workers, retirement, and the purpose of Social Security. The original vision of Social Security as a system that only served people who had fully stopped working has been gradually replaced by a more flexible framework that recognizes retirement as a process rather than a single moment. People move in and out of employment. They shift from full time to part time. They consult, they freelance, they start second careers. The rigid binary of working versus retired no longer matches the lived reality of millions of Americans. The earnings limit is a relic of the older, more rigid model. It was designed for a world where retirement meant you stopped working completely and where keeping older people out of the labor force was seen as economically beneficial. Neither of those conditions describes the modern economy or the modern workforce. Eliminating the earnings limit would bring Social Security rules into better alignment with the way people actually live their lives today. It would give workers more flexibility and more control over their own financial decisions, reduce administrative complexity for both individuals and the Social Security Administration, and remove a rule that for many people functions more as a confusing penalty than a meaningful policy tool. The trade-off is that it removes a structural prompt that currently encourages some people to think carefully before claiming early, and it would modestly accelerate the pace at which money flows out of an already stretched trust fund. Whether those trade-offs are worth making is a genuine policy debate. But what is not debatable is that understanding this proposal, understanding how it affects your specific situation, and planning accordingly is one of the most valuable things you can do for your retirement security right now. The rules of Social Security have changed many times over the past 80 years. They are changing again. And the people who pay attention to those changes and adjust their planning accordingly are the ones who come out ahead.